So I think enough people have joined in. So welcome everybody. Welcome to Marcellus's webinar on Little Champs. This is a special webinar from our sides because we have two special guests with us today, very distinguished guests. And I take good pleasure in terms of welcoming them and also briefly introducing them. Many of you are familiar with them, but I'll just take a couple of minutes to give a little bit of background. Our first guest is Dr. Mark Mobius. Mark's spent several decades in the world that we're interested in, which is investing, and in particular, spent more than 30 years heading Templeton's emerging markets business, particularly during the best times for emerging markets. And within that, he's invested across small caps and private equity as well. So thanks, Mark, for joining us today.
Pleasure. Thank you.
A second guest is Rajesh. Rajesh has been, long-standing colleagues with Mark at Templeton, again, working across emerging markets and private equity. He now runs a venture capital firm called Equanimity, which picks his best skills of working with promoters and entrepreneurs and management teams in terms of helping them build businesses, which is where the two of them bring immense amount of their experience to Marcellus's Little Champs portfolio companies. So great to have you here, Rajesh. Welcome to you as well. So we'll start off the...
Thanks for having us. Thank you.
So we'll start off the webinar with Mark's opening comments. Mark, these are special times, but I guess you've seen it all, given your vast experience. So it'll be great to have somebody with your experience across time and geography in terms of relating to some of us for whom this time is different. But if you can help us give your perspective and help us understand what to make of this situation, especially linking it to investing and markets, and in particular, India and small caps, that'll be great.
All right. Thank you everyone for tuning in. I hope I can give you some comments will help you look at this in some perspective. It's funny, when this crisis started, I was talking to some friends and I was laughing. I was kind of happy. And they said, what are you happy about? This is a terrible situation. There's a COVID-19, people are dying and so forth. And I said to them, look, people are dying every day in this world. I mean, if you look at worldwide, 60 million people are dying. And you have to put this into some perspective. And whenever there is some kind of big market downturn that we've seen, it's a wonderful opportunity in many directions. First, it's a wonderful opportunity to pick up bargain stocks, particularly in small and medium cap stocks, because they're the ones that usually get hit the most. So there's a lot of upside on that side. But the other thing is that it gives us an opportunity to sit back and do some reform. Think about how we can improve our lives, improve the way we've been doing things in the past. But those words, this time it's different. You do hear a lot now because they say, well, COVID-19 never happened before. It's completely different. It's worse than any other crisis. And I'm telling people, this time is different, the most expensive words in the world, because if you don't look at history, you're going to lose out. You're not going to have the right perspective of what we're seeing. And I decided when this whole crisis started, I decided to look back to the time when we started in emerging markets in 1987 with the first emerging markets fund. And I went back and I looked at 11 markets around the world. The US, Japan, Thailand, Korea, Brazil, United Kingdom, Turkey, Taiwan, China, Hong Kong, and India. And I calculated the bear markets. And by the way, I defined a bear market as a 20% decline. So I counted how many bear markets there were in these various markets and what was the degree of decline. And it was interesting to find that the average decline was about 49%. And the range, of course, was very wide, from 23% up to 92%. By the way, these are all US dollar numbers. And the average length of time of a bear market was 15 months. And by the way, another very important point, we measure a bear market from the peak to the bottom. not from peak to peak, which a lot of people do. A lot of people say, oh, we're still in a bear market because we haven't reached where we were before. No, the end of a bear market is when the bottom is reached and it begins to come up again. And by the way, in this study that I didn't account for the current crisis. I just went up to the beginning of this crisis. So the average decline was 49%. The average time was 15 months. Of course, the range was from 3 months to 3 years. But knowing that, I began to think, well, wait a minute now, this bear market seems to be very, very sudden. We're talking about 3 or 4 months, which is very, very short. And the degree of decline, depending on which market you're talking about, was anywhere between 30 to 40% roughly in that range. And I thought to myself, when people ask me, is it over? I mean, have we seen the end of the bear market? I begin to think, well, maybe we haven't seen the end, but I'm not going to take any chances. I'm going to start buying, which I started doing for my own portfolio. And of course, with our funds, we had about 10, 15% in cash, so we could put some of that to work. But what I'm trying to convey to people is that nobody knows whether there's going to be another fallback or what. But we do know that in this day and age of the internet, things happen much more suddenly and much more dramatically. So we've seen a very dramatic shortfall, and now we're seeing recovery. And I think the market is telling us that the outlook looks good because we're seeing pretty good recovery in many of these markets. But just looking at India alone, if you look at what happened in India, the declines in the past were more numerous. About 8 times we've seen bear markets in India. And generally speaking, the reactions, the recoveries have been pretty fast because you do have these very rapid declines that get over very, very quickly. So I think the outlook for India, I believe, is pretty good. It's going to be a recovery. There will be some problems along the way, but I think there's a great opportunity now to be looking particularly at the small and medium-sized stocks. So that's my general beginning comment, and let me turn it over to Rajesh for his comments.
Thanks, Mark. That's as always, we are all looking here to dip into your immense experience, something I've benefited over the last couple of decades. I think there's not much I can add to what Mark has to say, but I think briefly looking at India and the smaller and mid-sized companies, I actually, from our point of view, agree completely with him when he says that the opportunity is large. And there is an opportunity. One of the few tenets that Sir John Templeton had was that you have to start buying when there's blood on the street. And I think if there's one thing, the human beings are not on the street anymore. It's all locked down here in Bombay, but there's enough blood on the street, and I can assure you, it's all of our blood. Right? We are all investors. It's our blood. I think we have to be very cautious about what we buy into. The world has changed. These are difficult times. I was just reading somewhere that the word unprecedented has been used now an unprecedented number of times already. So these are difficult times. We have to be very cautious and careful about where we dip our feet into, what kind of companies do we buy, what kind of businesses do we back. And I'm very happy to say that our partnership here with Marcellus, Saurabh, Pramod, and Ashwin and their team, the way they think about businesses, the way they think about putting a portfolio together, me and Mark, we remain very impressed by the way the value that they bring to the table. And that's one of the reasons why we thought that we should, associate with Marcellus and the team there. Specifically about India and small caps, depending on what index you look at, what measure you use to measure small caps, I think that index is down some 30-40%. The bad news here is that that index, broadly the stock market itself, was anyway facing troubles before we got into this COVID situation. And not just small caps, even large companies and their balance sheets were really under stress and duress even before we got into this whole COVID thing. So using COVID as an excuse, I think is not the right approach to investing in India. We have to be a little more, we have to look at it more from a macro point of view, a little more broader point of view. And this is the time to back businesses which have inherent strengths, which in our opinion and our expectations will be as robust and solid once things get back to normal. So the way at least we are thinking of putting together portfolios or thinking about companies and their businesses is to divide them into three zones. The first one is a 3 to 6 month kind of outlook. The second is a 12 to 18 month outlook, and the third is 18 month plus. So when you try to value a company or do a DCF, etc., I think the three buckets that I just defined is how we look at businesses. Because of the current situation, your numerator, the cash flow, the variability has gone up. So there is some risk to our valuation models. So the kind of valuations we were thinking of before March, before February were very different than what we are seeing now. The discount rate obviously has therefore changed, and so the overall market valuations, etc., and the valuation for specific businesses has changed. So I think it's a time where all of us in our conversations are approaching the situation with an open mind, and as long as you take into consideration.
You went on.
I think we lost
at the end of the tunnel. Sorry, am I audible?
No, we just
yeah, you're back. You're back on now.
Oh, okay. So as I said, I don't know where you guys lost me. So I'll just continue where I was. What I was saying is we have to keep in mind.
Rajesh, you were talking about valuations. You're talking about valuations as to how valuations are very different now from back.
Right. So when you value a company, you use a DCF kind of model, and both the numerator, which is the cash flows, and the denominator, which is a discount rate, I think both of them have got changed and altered in these times. As long as we are cognizant of those changes to valuations and changes to inherent businesses, I think we'll come out better at the other end of this opportunity. So there is a huge opportunity as long as we are cautious and careful about it. It's important for us at Equanimity to keep this in mind, because when we deal with companies, and we are talking of now small cap companies and companies that Saurabh and his team have put together in the portfolio, our role is more to work with the founders and promoters and the management teams of these companies and share our perspectives and how we can bring to bear global knowledge and our experience with these smaller companies. So when we talk to these companies and the broader set of smaller companies, some of the conversations we have is around enhanced levels of risk and how do we manage those risks. I think that should suffice as an opening comment, and I think more of that can be answered as we get into a Q&A after Saurabh and his team have gone through the presentation that they put together.
Oh, good. Thank you, Rajesh. By the way, just let me add one thing. In looking at the portfolio that your team has put together and looking at the Marcellus portfolio, we must remember that a lot of the stocks are doing quite well in the face of these problems, simply because they were prepared for some problems. And more importantly, they were in businesses that could benefit from more distance kind of communication and delivery. So I think it's very important to remember that it's not a disaster for everyone in the market.
Absolutely. Thanks, Mark. Thanks, Rajesh. So what we'll do is, I think, just taking a cue from Mark, start with the portfolio performance, because I'm sure there are lots of people on this Zoom call who will be petrified as to what's happened to a small cap portfolio. Surely it must be crushed. So Ashwin, if it's possible, can we just show the portfolio performance over the last since inception? 29th August is when we kicked this off. And one point that Mark just made, I'll use that to segue into the portfolio. Howard Marks made the same point in his recent memo, right? So Howard Marks wrote a memo last week on uncertainty. And what was very interesting about the Marks memo was he highlighted how great investors deal with uncertainty, right? We are not yet great investors. Maybe 20 years from now, we might be. But what he highlighted was how smart promoters, good companies, and good investors have a very similar mindset, right? How they prepare for contingencies in the same way. So, for example, having businesses which are generating high amounts of free cash flow, having strong financial reserves, having staff on the payroll rather than contract manufacturing, having distributor dealer relationships which were strong, hold up in times like this, are all the hallmarks of successful companies. And if you see how great investors invest, there's a lot of that, right? I mean, we've read about great investors in our country as well. The ability to build portfolios which are resilient, right? The ability to build portfolios which are resilient in difficult circumstances, which hold up in difficult circumstances, is the sign of a successful fund. So here's the performance. So we started on 29th August. Since inception, this is, by the way, till the beginning of the month. We'll give you this month's performance as well. So at the beginning of the month, we were up 8%, and the relevant benchmark. Ashwin, just stay there, Ashwin. Yeah, just stay there. So we were up 8% till the beginning of the month, and BSE small cap, as you can see, as the relevant benchmark, was down the best part of 10%. So was the Nifty. Right. So one of the things we've consistently challenged when we've gone to the market explaining this product to people is the Nifty is not a low risk offering compared to small caps. Small caps are not higher risk. It all depends on how you do stock selection. So at one level, I'm quite glad we've been through this shakedown over the last 3-4 months, because it allows us to demonstrate this. Right now, look at what happens in February to April. Right, Nifty goes down the best part of 24%, 25%. Sorry, BSE small cap goes down 24%. Nifty goes down 17%, and this portfolio goes down 10%. In the month of April, the market rallies. We go up 17%. So whatever we lost through January, February, March, Little Champs made it back actually in the first 20 days of April alone. Right. And where we are today is 6-7 months into this whole COVID issue. We're in a position where the portfolio is actually making money. Not only are we making money, look at the volatility statistics in the lower part of the page, right? A standard deviation is no higher than the standard deviation is actually no higher than small cap, lower than the Nifty. Our drawdown is lower than the Nifty, right? And this is what we had promised when we started marketing this 6 months ago, that we'll be able to give you, by choosing high quality small caps which have 3 characteristics: market leading franchises, dominant franchises, clean accounts, products which are essential for life in India. We should be able to give you comparable volatility to the Nifty, but much superior performance. And even in this snapshot that we've had from 29th August to now, you can see that coming through. Now, this is we intend to run this for another 3 years or so. So, 6-7 months is simply not long enough. How is the portfolio constructed? Why is it so resilient in the face of distress? I'll hand over to Ashvin Shetty, the fund manager, for him to take you through this.
Oh, thank you, Saurabh. Some of you may have already heard from me actually in detail about this process. So just to keep adequate time for the Q&A session, I will try to cover it briefly. So this slide in front of you actually summarizes the process that we followed. So if you look at the universe, there are more than 1,000 companies when we talk about less than $500 million market cap companies in this space. Obviously, most of these companies are unknown, they are undiscovered. So, and at the same time, it is not possible to do a deep dive, bottom-up research on all the 1,000 companies. So what we do is that, we divide this process into 2 parts. So first is the second and the third box here are the quantitative frameworks which we employ. So via these quantitative frameworks, we bring down the more than 1,000 companies straight away down to 40 to 50 companies. And on this short list of 40 to 50 companies, then we do a deep dive, bottom-up research and diligence. Covering the quantitative frameworks first, the first and foremost framework which we apply is the forensic accounting screen. So any company in India, and more particularly in the small cap space, I think this is the first filter anybody should apply. Basically, you should have comfort whether the numbers that are reported by the companies, they actually represent a true and fair view of their operations. So how we do is that we use here a battery of 12 accounting ratios. So anybody, I can get into details in the Q&A session, but briefly what we look is that how much of the reported profits of the companies are getting converted into cash. How much free cash flow are the companies generating? What is the quality of their auditors? What is the extent of the off-balance sheet liabilities? So on and so forth. We use 12 such accounting ratios. We give score to all the companies individually on these ratios, aggregate their scores across these 12 ratios, and finally on the aggregate score, we eliminate the bottom 40% companies, the companies which score the lowest, bottom 40%, because our model is saying that prima facie there is some issue with the accounting quality of these companies, and we follow what our model is saying. So straight away here, 40 to 50% out of the 1,000 odd companies which we started, they get eliminated at this stage. So we are left with around 400, 500 companies, and where we have reasonably good degree of conviction that at least the numbers which we are seeing are realistic, reliable. So the next step which we are actually trying to do is find the strong companies among this. So here we use 5 ratios. So first is the growth, revenue growth. We look at the 6 years of financials. The first ratio which we use is the growth. And the other 4 ratios which we use are gross margin over the last 6 years. What is the average working capital days trended over the last 6 years? How is the fixed assets turnover trended over the last 6 years? And how is the interest coverage ratio moved over the last 6 years? So essentially, put in a summary, we are looking at growth and we are looking at the components of the ROC. So ROC is nothing but your margin, your working capital, and your fixed assets. So essentially, we are looking at growth plus ROC combination in a sense. But instead of focusing on the headline ROC, we are looking at the components of the ROC and seeing how the company is showing the performance over the last 6 years in these parameters. So what we do is that on these 5 ratios, we rank the 500 odd companies which we started this stage. We calculate how their numbers have moved over the last 6 years on these 5 ratios. Give them individually percentile rank on all these 5 ratios. And we select companies which score more than above average, which score above average on all the 5 ranks. So here we are looking at we are giving actually importance to all the parameters. So in the case of forensic, we are looking at the aggregate score, but here we want a minimum threshold on all the 5 parameters. So a company, for instance, is scoring very well on growth, but that growth has come at the expense of inflating your working capital, your margin going for a toss. That company will not get selected under this framework. So we are looking at companies which are growing, but which are growing profitability without putting their balance sheet into any kind of duress, and cash generating companies. So this is quite a stringent screening parameter. So out of the 500 companies which are left after the forensic framework, more than 90% companies get eliminated. In other words, we are left with only 40-50 companies which sort of comes after this parameter. So if you look at these 40-50 companies, they are essentially healthy ROC companies, cash generating companies, growing companies. But some of you may have questioned whether this approach is correct, or similarly, we also internally debated it. So just to test whether our approach is correct, both this forensic as well as this business parameter frameworks, they are actually robust. What we did is that we backtested the shortlist for the last 10 years. So if you see in the top left, the bar chart, the dark blue line is the return of year-on-year return of the algo. So basically, just to recap, we are still now at the framework level. We are not applied our brain. Everything we are doing basis the Excel frameworks that we have prepared. So the dark blue line represents the returns. So you'll see that the 9 out of the last 10 years, the algo return has been higher than the BSE small cap return, and in nearly 7 years, the algo return has been better than the Nifty returns. And if you want to look at the summary of this snapshot, you refer to the table on the right side. So if you look between CY10 to CY19, the algo returned a CAGR of 18% compared to BSE small cap of only 2% between CY10 to 19, and Nifty and BSE 500 of 9 to 10%. So substantially better than the benchmark BSE small cap, but even better than the large cap indices. And if you look at the third column over here, standard deviation or the volatility, its volatility is actually closer to BSE small cap. So for the same kind of volatility, it has returned 9x better return than the BSE small cap. And the last column, the maximum drawdown, actually, in fact, it's much better than BSE small cap anyways, but actually it is almost similar to the Nifty and BSE 500. So what actually Saurabh was talking about, so the substantially better return compared to similar standard deviation, or even better standard deviation and drawdown compared to the indices.
I think
So as
the
there is,
point,
yeah.
point worth just 1 second. So, folks, this is a design feature. The fact that we are able to generate significantly superior performance to BSE small cap and Nifty with volatility comparable to Nifty is not a fluke. It's a design feature. Yes, we have done it over the last 6, 7, 8 months. But as Ashwin is emphasizing, because it's a design feature, we should be able to do this over the next 3 years as well. Back to you, Ashwin.
Yeah. So this the success of the algo has given us a lot of conviction actually, and this is visible in the slide in front of you guys. But obviously, this shortlist which we have is around 40 to 50 companies. Our style is to basically invest in 14, 15 companies where we think we can actually go into. From a monitoring perspective, also it makes sense that number 14 to 50 companies. So coming down from 40 to 50 companies is again, we do a lot of effort. So in summary, actually, we do 2 steps. One is analyze as much as possible all the secondary information available on the company. So one of the rich source of information is the annual reports. And we end up reading anywhere between 10, 15, 20 years of annual reports. So we just don't rely on the last 2, 3 years of annual reports because this has advantages. So when you go back into as much as in the history of the company as possible, you are able to identify the key inflection point, of the companies or the key, stress points. Like for example, before COVID, I think Lehman is one of the sort of the distress point in every corporate's life. So how did the promoter react during that time? How did it manage the situation? So going back into the history gives a lot of information on the character of the promoter and particularly how he deals in during the tough situation. So that is very important. And besides analyzing the secondary information, we also do a lot of channel checks actually. Obviously, we meet the management time and again, anywhere between 2, 3, 4 times. But more important than meeting the management, we also do a lot of channel checks, particularly with independent people, be it competitors, be it suppliers, be it the customers of the company and ex-employees. So that gives us a lot of the insights. So what happens is like after the quantitative framework stage, the 40, 50 companies, they invariably have healthy ROC. But what we are trying to do here is that what is the reason behind that ROC? What are the drivers? Whether they will sustain. That is what we are trying to focus in the bottom-up research actually. So we try to understand what is the driver of their leadership, what is the driver of their ROC, and we try to gain conviction on whether those are going to continue, where there are sufficient entry barriers in the industry. This takes a lot of time actually. So quantitative frameworks is very simple. You run the Excel framework, but bottom-up research, particularly in small caps, takes a lot of time. One, that these companies are not known. So it's very difficult to find people who may be having information on the company. Secondly, trying to convince them to meet. After meeting, also trying to get the right information from them, and finally processing that information in a proper framework, which gives us conviction on both the integrity of the promoter as well as the moat of the company. So it takes a lot of time. So at Marcellus, actually, for a team of 5 to 7 analysts, last year it took almost 12 to 13 months to go down from 40 to 14 companies right now, which we have in our portfolio. So
I think just to, Ashwin, if you don't mind, I'll just butt in here. So we've added 3 champion CAs. So that team last year was 5 chartered accountants. We've added 3 more champion CAs. Intensely rigorous process by which India's finest chartered accountancy talent is brought into the firm. And I'll tell you the utility of it, both for you as an investor and for me as someone who's managing the franchise. On one of the stocks, one of the pharma stocks that we were thinking of buying, 4 months ago, there was a concern that in some of its overseas subsidiaries, there might be a challenge because 4 months ago, as the COVID cash flow problems began across the world, there was a concern that there might be a cash flow challenge, right? So Ashwin and one of our ace chartered accountants in the team worked on this market cap of the company would be what, $300 million on this specific challenge on is there a cash flow problem on one pharma company's overseas subsidiaries. They worked on it for 3 weeks flat. Right. And after doing that, speaking to distributors abroad, speaking to the auditor in India, speaking to the CFO, speaking to the promoter, doing forensics on subsidiaries accounts in the rest of the world, we were able to ascertain this fellow isn't lying. He doesn't have a cash flow crunch. Right. That is the degree of detail we are going into. in companies with $300 million market cap, right? A, it's a question of having the skill set. Others in India might have it. B, it's a question of having the staffing and the manpower. I doubt any other team in India has this degree of forensic firepower.
Yeah. So right now we have 14 stocks in our portfolio. So this is how the fundamentals at the portfolio level look. So from FY14 to 20, on a weighted average basis, Little Champs have delivered 21% earnings growth. And this period, as all of us know, that has not been very, very conducive for the corporate earnings growth. If you just look at the Nifty earnings growth over the last 6 years, has been only 3% CAGR. And similarly, BSE small cap has been 10%. In fact, that BSE small cap number is a bit inflated because we have considered only the companies with positive earnings. Actually, if you consider the loss-making earnings, I don't think BSE small cap has delivered positive earnings over the last 6 years. So in a very tough corporate macro environment, these companies have delivered. I'll go into depth into the subsequent slides why it is possible, but these companies have delivered 21% earnings growth. And similarly, last year, FY20, which again, all of us know that has been one of the most challenging years, actually, these companies have delivered 20% ROC in a very, very tough macro year. And because these companies generate so strong ROC, they have so strong pricing power, and their products are like sort of essentials. Because of this ROC, they are able to generate significant cash flow, significant internal accruals. And because they are able to generate significant internal accruals, most of their growth is funded by the internal accruals. So they don't have to rely on the external debt. So if you look at the small chart on the right side top, you'll see that 90% of the Little Champs funding requirements have come from their own internal accruals. So they didn't have, unlike the small cap peers, which is the lower bar, unlike these normal small cap peers, who go on for a lot of external debt as well as equity dilution, these guys have met most of their growth requirements from their internal accruals. And because most of the growth requirement is met for the internal accruals, as a result, if you see the net debt equity column, most of the Little Champs portfolio have net cash on their balance sheet. Actually, in fact, the portfolio is actually net cash on a weighted average basis. And this actually is helping them, keeping them in good stead in this current environment. And just before going into a little bit on the portfolio from what is the current impact from the COVID. So I just like Saurabh talked about the Little Champs performance over the last 8-9 months, and particularly in the last 3 months. Similarly, the great financial crisis examples of also you can see in the bottom chart actually. So obviously we didn't have Little Champs at that point in time, but if you do a simple portfolio of quality small caps, you take companies with ROC of 20%, earnings growth of 15%, and net debt equity of less than 1x, you'll see that between Jan 2008 to March 2009, which was the bottom of the Lehman, these companies fell almost 20% lower than the BSE small cap index. And more importantly, from March 2009 to November 2009, they recovered very, very fast, compared to the broader small cap universe. And in fact, by November 2009, within a matter of just 8 months, they had reached their Jan 2008 peak levels. And subsequently in 2010, they went on to create a huge return for the investor. So this is all we also expect the Little Champs portfolio to do. So not only fall less during the crisis, but at the end of the tunnel, they will emerge healthier. They will recover very, very fast. And over a 3-year period, they will make a lot of returns to our investors. Unfortunately, we don't have the Nifty bar over here, but as Saurabh said, I think most of the people when I interact with, they feel that this is the right time. This is a time to look into large caps rather than small caps. But what we say is that irrespective of caps, look at the quality companies actually. So bad large caps will lose you money irrespective of whether it is COVID or post-COVID. Similarly, good quality small caps will make you money irrespective of what is the situation. So rather than focusing on the market cap of the companies, focus on the quality and the management strength of the companies. So that is the approach we recommend to the investors. And coming specifically, I'll quickly take you through. So coming specifically with the impact of COVID-19 on Little Champs. So we see a minimal impact. Obviously, for the next 3 months, there is no denying that every company will have an impact. There will be no revenues, and every company will have to incur fixed cost. But what will help the Nitijan's portfolio is their strong balance sheet. So if you look at the third column over here, as I said, most of the companies, actually you'll see negative sign from most of the companies. They are actually net cash actually. So most of the companies have surplus cash in their balance sheet, and those with debt also, nobody has more than 0.50x actually. So whosoever has debt is also very low debt on their books. So even if you conservatively assume that for the next 6 months, these companies will continue to incur cash fixed cost, they'll continue to have their cash burn. The picture will not change significantly at the end of at September 20, say after 6 months. So most of the companies will still have net cash on their balance sheet. At the portfolio level, the minus 0.11x will just change to plus 0.11x. That's it actually. So none of the companies we think will have any existential crisis. So in fact, we think that they can not only survive, but they can continue to invest in their business growth. They can continue to attract and retain good talent. They can continue to work on product development. They can continue to invest in expanding their distribution network. Shortly put, it will be business as usual for them. Whereas for most of their peers, actually, it will be a matter of survival, actually. So BSE small cap index level, the debt equity is close to 0.8, 0.9x. And I'm sure that most of the companies will be on the other side of that numbers. So for them, actually, it will be a matter of survival. So in other words, they will not be able to grow that focus. At least they will not focus on growing their business. It will be a matter of staying alive actually for them. So we think at the end of the tunnel, actually, the Little Champs will emerge stronger, whereas most of their peers will be badly battered and bruised, actually. And that will put them in a very enviable position. So we think they will go on consolidating their market share. And it's a sort of a good opportunity for them. Similarly, at the financials companies, which are there at the bottom two rows. So if you look at the NBFC, the tier 1 capital is 29% for the NBFC. I would I would say that no NBFC in India has so much liquidity that this NBFC portfolio company of ours has. So very, very strong firepower, which will, again, it's like a gold in the current situation. Liquidity is the king in the current situation. And this NBFC will again benefit from that, and it will be able to consolidate its market share in the current situation. And coming to the second slide, some of you had raised concern that Little Champs do have exposure to export markets, and given that there is a risk of the global recession and how their export revenues can take a hit. Again, here, if you look, we do have companies which have sizable export revenues. So 6 of our companies have more than 20% export exposure. So more than 20% of their revenues come from exports. But if you look at the remarks column, you will be sort of rest assured. So look at stock 1, stock 3, and stock 5. So their end user industry is pharma actually. So we don't think, whether it is recession or not, if there will be any impact on the pharma industry. The stock 1 is actually a leading supplier of the specialty chemical to the pharma industry. Stock 3 is a leading supplier of equipment to the pharma and agrochemical industry. Similarly, stock 5 is in fact a pharma supplier. So we don't see any impact of global recession on these stocks. And the stock 2 again is a supplier of products to the staples, actually, fishing industry, aquaculture industry. I don't think people will stop eating fish irrespective of the recession. And one company,
just on that. So folks, these points that Ashwin is making, right? This is not us sitting at home and just fantasizing about it. In all of these cases, we are checking with the company, then we are checking with the end market, either with the end customer, or say in the case of stock 2, we're calling up companies who use fishing equipment that stock 2 manufacturers, and we are cross-checking with them as well, right? So it's not just a question of taking at face value whatever the promoter tells us to give us comfort. It's also going into the real world and cross-checking. We do this in CCP as well, but we've also realized that it's a good discipline to have, and hence it's being applied to LCP as well, even in the case of companies where the end markets are far away from India. Back to you, Ashwin.
Yeah. And we do have an auto ink which has like more than 40% exposure to the export market. But fortunately, again, it's a supplier of a small ticket component to the replacement market rather than the new vehicle sales. I don't think people will stop driving the car actually. In fact, they may actually use more cars going forward. So again, we don't see any impact, of any likely or potential global recession on these companies. So we are pretty comfortable with the companies which we have. And finally, from my side, so this shows actually the FY14 to 20 earnings performance for individual companies without naming the companies. So most of them actually have not only survived, they have thrived in the last 6 years. Again, I'll repeat that, last 6 years have not been very, very good for the macro environment and corporate earnings. These companies have actually thrived. And I can possibly see two main factors. One is that they have consolidated their market share. Much of their earnings growth, revenue growth has come from gaining share from the weaker peers, which again, we think that, it actually can happen at an accelerated pace over the next 6 to 12 months. So that can happen again, what they have been doing in the last 6 years, that can happen at an accelerated pace in the next 6 months. And finally, they have used their capital allocation skills very, very smartly. So capital allocation is a double-edged sword, actually. It can either make the company or break the company. A company which actually goes into non-core business, invest into, say, real estate sector or businesses which are outside of their core competency, they end up destroying the franchise. But in case of Little Champs, they have actually used their cash from the core businesses and actually growing their core business in the sense that they have got into adjacencies, say an auto ancillary company pushing more products to the same customers, or bringing in new customers for the same product, or getting into new geographies. So they have used their cash from their core business very smartly to grow their business. And that is also one of the reasons why you see the numbers of earnings growth, third column, for most of these companies have been quite ahead of the general corporate earnings growth over the last 6 years. And we think, again, they can, because of their superior capital allocation skills, that can continue to happen in the future as well. So yeah, so I will stop at here and over to Pramod actually for the Q&A.
Thanks, Ashwin. So we'll get on to some questions. There are several interesting questions. I'll try and combine a lot of these so that we can make the most use of our panelists' time. I'll start with Mark. Mark, I think an obvious question for you. Several Indian investors have seen their investments in the Indian market significantly underperform that of the US market. I'm sure you would have experienced this. I'm sure you would have experienced this phenomenon in other emerging markets as well. So the question from an Indian saver is, do we diversify our asset allocation to include more of global assets, in particular US assets, given what we are seeing in the Indian economy itself, that increasingly our usage or our impact from US companies, be it say Amazon or Facebook or Google. In fact, the last 2 months, most Indians have derived their entertainment from Netflix, which is an American company. To that extent, is not having US companies in your portfolio sort of a weak spot for an Indian investor? How should you go about it?
Well, there's no question that any investor must be diversified globally. I mean, I'm surprised that many investors in India are not going into not only the U.S. market, but other markets around the world. Because, India has great companies, there's no question about that, but there are also great companies every country in the world, and particularly the U.S. market, because the U.S. market is so big. And you must also remember that the U.S. market represents companies that not only are U.S. companies. For example, Alibaba, the Chinese internet company, is a U.S. listed company. So it's very, very important that you be diversified, particularly in the U.S. market. Now, if you haven't done so up to now, maybe you're a little late. It probably is a good idea to wait and invest in India at this stage, because India is down so much. You must go to places where the markets have suffered the most, because those are the markets that will recover nicely. And we know that India has been on a growth path, and probably because of this COVID-19 crisis, the reforms in India will come faster and therefore will accelerate the growth going forward in next year and the following years. So bottom line is you have to be diversified, but maybe not a good time to do it now.
Right. Fair enough. So in terms of India's relative position within emerging markets, in particular, the unavoidable comparison with China, and given your experience across emerging markets, there have been questions, several questions around, we've been hearing news, bits and pieces where the Western companies are shifting capacity from China to elsewhere. In that case, do you see India becoming a big beneficiary of the shift in the coming years? If yes, are there any particular areas do you see this happening more than others?
There's no question that India will be a beneficiary of this trend. You must remember that India already is a beneficiary of outsourcing. I mean, if you look at these huge companies like Tata and others, they are producing outsourcing products sitting in India and communicating with countries all around the world and then moving into consulting. So it's a big, big area for India already. So India has been benefiting mainly because Chinese have not had the English speaking ability that the Indians have, and therefore the Indians have been able to take advantage of that situation and promote their software and their outsourcing products. Now, the next step, I believe, for India is to begin to serve as an outsourcer for actual physical products, production, producing cell phones, producing telecoms equipment in every direction, and so forth and so on. But a lot of that will depend on the speed at which the Modi government can institute reforms, particularly in labor reform. Now, I know that labor must be protected. There must be certain rules and regulations on how labor is hired and fired and so forth and so on. But they have to be competitive. The rules in India have to be competitive so that you can invite these manufacturers in and say, look, we've got a very nice labor market. We've got a lot of labor that wants to work and can work hard, and you're going to be able to hire them, and it'll be easier for you to do that and to be flexible. So I think there's going to be a great opportunity for India going forward, provided that these reforms are put in place.
Fair enough. And here's the most often asked question. I'm pretty sure you get asked these questions across the globe as well. It's about timing the market. And I'm pretty sure there's no better person on this panel to answer this question, given how many times you've seen these drawdowns. So people are asking, should I wait for the market to bottom out? Should I sit on cash? Should I stagger my way in? Should I jump in now? So all sorts of questions pretty much asking the same thing.
Well, the bottom line is that you've got to be invested now, because with all the bad news, pick up the newspaper every day and you'll find more bad news about how many people died from COVID, et cetera, et cetera. As Rajesh said, the best time to invest in is when there's blood on the streets. Of course, we really don't mean that, but the best time to invest is when everyone is despondently selling. And maybe we're not to that point or past that point to some degree, but still there's a lot of opportunity now. So you cannot wait. This is the problem I pointed out earlier. A lot of people say, oh, we're still in a bear market because the market has not reached the high point where we started. Well, no, you're going to be too late, because if you go from 100 to 1, that's what, 90 plus 99% decline. But if you go from 1 to 2, it's 100% increase. So you want to be at that 1 point. Well, you want to be buying stocks when they're down, because the percentage increases are going to be in your favor going forward. So very important that you be invested now. I'm not saying throw everything in the market. I personally invested a lot in the last 3-4 months, and but I still have some cash reserves to put in the event that there's a downturn again.
Fair enough. Thank you. This one's for you, Rajesh. I think there's some questions around particularly your role and Equanimity. You're in Mark's role with the Little Champs portfolio, which you alluded to in your opening remarks. And there are some follow-up questions on that. First of all, if you could elaborate your role, how do you go about working with promoters and management teams? And within that, question about look, we're not going to have a board seat. We're not going to be a significant shareholder. An experience of dealing with Indian promoters hasn't been that easy in terms of getting them to listen to your advice. What are the typical challenges you face, and how do we go about addressing that? It would be great if you could throw some light on that.
Pramod, forget about Indian promoters. It's very difficult to get your spouse to listen to you or your kids to listen to you. So it is a challenge. So I'm going to go back a little bit into history. When I was, doing my MBA, this is 94 to 96 from XLRI, there used to be two batches. One was a business management batch where I was part of. I did finance and marketing. And the other batch was HR. So it was largely human relations and softer aspects of business. And it was a general consensus between all of us that the smarter ones are in the business part of the school, and the others are the HR. And I can't tell you how many times I've reminded myself how wrong we were. Right? I think the biggest challenge is dealing with people at all levels. So I go back to Ashwin's slide where he had that whole filtration process, and you had quantitative factors and then qualitative factors. There's only so far that life can take you, or your investing experience can take you, if you rely too much on quantitative. I think qualitative is as important when you're finalizing where to deploy your capital from a capital allocation perspective, or from within a certain asset class, what portfolio to set up. So when I started investing, with Mark and his team in '99 onwards, I of large cap companies and more AUM, etc. And in the year 2000, we first private equity fund at Templeton, which Mark pioneered. And for the next 17 years, when I worked with companies on the private equity side, I think it gave me a huge exposure to understand not just about how to put together a portfolio, but once your portfolio is in place, how will you generate that alpha? How do you work with promoters and the management teams, not to push them in any one direction, but to understand their perspective first, and then to help them in pursuing their goals, bringing to bear your global experience. And I think that is the key. So at Equanimity, it's a venture capital firm. We invest in early stage companies where I think 70% of our work is after the portfolio is put in place. So 30% of our effort is to figure out, the companies that we want to back. And 70% of our work, I think, is once you've invested, then how do you work with the entrepreneurs, the founding teams? How do you work with suppliers, customers? What kind of decision-making, prowess do you bring to the table, etc.? And I think one of the points that Saurabh made in the beginning itself, and I think also Ashwin alluded to that, is with smaller companies, they behave very differently than the larger ones. It's the mindset of the people. You saw the complexion of the portfolio as well. Most of the companies are pretty strong companies as such. The balance sheets are pretty strong. The cash flows are strong. So these are smaller businesses run by promoters and their families and management teams who really know what they're doing. So it's a challenge working with them and trying to give advice to them as to what they should do. But our role, more or less, is therefore not to tell them what to do, but to help them in whatever they're doing. So you can think of us as a consultant to the portfolio companies, or as people who are well-wishers of those founders and the promoter family and the management teams. And we not only handhold these guys, but we largely bring to bear our experience in similar industries or similar businesses at similar scales in other parts of the world, and how things panned out for them. So that essentially, in a nutshell, is how we see our role playing out with the Marcellus Little Champs portfolio.
Well,
Saurabh, you want to add something?
Yeah, so I'll give an example actually. So one of our portfolio stocks, right? Very successful company, pharma company, right? And Rajesh went to meet the promoter. I wasn't there actually. Rajesh and Ashwin went. I heard later on what had transpired, and I'm glad Rajesh went with Ashwin. So simple issue, right? The successful promoter, family, basically listed company, but a family-run concern. Promoter and his kids run the business, right? There was some degree of opacity on the financials of the subsidiaries, right? The opacity that I highlighted 40 minutes ago, which we are one of our two ACAs ripped apart to understand the opacity. Now, this promoter didn't know that the subsidiaries accounts also have to be made available to the public, right? So nobody had ever told him that. This is a listed company, successful company, has been around listed for 30 years, but nobody had told him that the subsidiaries accounts have to be made available to the public. After that meeting, we realized, made the point to him that, look, you got to do this, and the promoter is going to do it, right? He's a straightforward fellow. Because he hadn't done it hitherto, all sorts of whispers had started circulating about subsidiaries cash flows. As he makes the numbers public, that issue gets addressed, right? So we still aren't such a developed market for companies with 2,000, 3,000, 4,000 crores market cap. Many of them simply don't know how to conduct business in the open market economy. Basic hygiene vis-a-vis investors, corporate governance is something that needs to be conveyed to them. We in Marcellus have some experience of it, but Mark and Rajesh have 3 times as much experience. When they meet these promoters and they convey that, it's far more effective. It helps the company. Compounding moves forward. Our clients benefit, the company shareholders benefit. Everybody gets a fair deal here.
Great.
By the way, there are just 2 points I'd like to make. And first of all, that what Ash and Saurabh have been talking about in the latter part of the presentation is meeting with these companies, and not meeting only once, but 2 or 3 or 4 times is an incredible testament to the kind of work they're doing, and is so critical, because after so many years working in this field, and Rajesh will verify this, we found that the numbers are just one part of the whole picture. It's the people behind the company, and you have to really get to know them. And I think that's why, the kind of work they're doing, that Ashvin and Saurabh are doing, is really very, very critical, and I think it's going to have very good results. The second point is that in talking to the entrepreneurs that Equanimity have been investing in, to me, it's amazing the number of really bright young people with incredible ideas and incredible ambition are in this team of people we're working with. It's just quite impressive. I can't help but think that these people are much smarter, much more ambitious than I was at their age. So it's very, very exciting to see how they're developing, and I'm sure we're going to find some terrific winners.
Thank you. Thanks, Mark, for that. So the next question is to you, Saurabh. Given your recent blog, which has gone viral, talking about the Leviathan and how there's a rising concentration of profits in India. People are asking, why then do we bother about small companies? I think there's a distinction you would like to make. What do we mean by large companies in every industry, and differentiate that between large cap versus small cap? Associated with that, there's several people asking the question, should we increase that asset allocation wise towards large cap, given they tend to be the first ones to recover? And therefore, the ultimate question, I want to give all my money to Marcellus. How much should I put it in consistent compounders portfolio, and how much should go into Little Champs portfolio?
Okay. Well, first of all, you must remember that this small cap stocks become big cap stocks. I mean, the big cap stocks were not always big caps. They started small. So I believe that the Marcellus portfolio will soon be changing its name from Little Champs to Big Champs. I mean, that's really what we're objective. The objective is to do that. And if you just invest in the large cap stocks, you're going to lose that opportunity. The large are already large. There's not much more to do going forward. So I would say in terms of investing, it depends on how patient you are, how old you are. But my feeling is that if you're young, if you're ambitious, you got to think long term. And now is the time to be investing in these small and medium cap stocks. You're not going to make a killing 1 year or 2 years, but 3 or 4 or 5 years forward, you'll do very, very well. And you're going to see some of these small cap stocks turn into large cap stocks. And I remember, John Templeton, when he was, he was about 80 years old, and he was buying some stocks, small cap stocks. And we said, John, do you think this stock is going to perform in the next 2 or 3 years? He said, oh, no, I'm buying it for the next 10 years. And we thought to myself, here's a man who's 80 years old. He's looking at 10, 15, 20 years ahead. And that's the way we should all think. That's the way I think anyway. I'm in that age bracket.
So I'll take it exactly from where Mark left off. I think there's two types of churn that we got to focus on, right? So one is the top 20 Leviathan churn, right? So as we highlighted in that blog, the top 20 profit generators in India take home 75% of India's profits, right? Up from 15% in 1990, right? Staggering change in the country. 15% in 1990, 75% of India's profits going to the top 20 profit generators, right? But there is churn in that top 20 list, right? Every decade, the top 20 list churns by 55%, right? So I'll put good money that several of the consistent compounders are already in the top 20 list, HDFC Bank, ITC, for instance, but several more are going to make it. So for example, Asian Paints is an inevitable entrant into the top 20 profit generator list. The top 20 profit generator list churns by 55% every 10 years. So that's the kind of elite level, right? That's the, the champion of champions level of the Indian market. Then the next level of churn, the one that Mark just nicely highlighted, is the BSE 500. Every year, 50 stocks fly into the BSE 500. Obviously, 50 go out. The 50 stocks that fly into the BSE 500 compound at 55% CAGR in the 3-year flight path into the BSE 500. As Mark said very nicely, they go from little to big in 3 years. A consistent compounder's job is to catch those companies before they become Leviathans. Little Champs' job is to catch those companies before they go into the BSE 500. So there are two different levels. One is the elite level, the heavyweight championship of the world, where Asian Paints goes into the heavyweight championship as a top 20 pad generator, money machine. I think they'll be followed in due course. I think Kotak Bank is 21 or 25 on the list. So Kotak Bank going into top 20 is inevitable. Asian Paints going into top 20, almost inevitable. Similarly, Pidilite in the next 10, 15 years, almost certainly, I think will go into the top 20. That's the elite level, top 20. Then the next level is BSE 500. Can you make it to the top 500 companies in the country? 10% per annum churn, right? 10% per annum churn, which on a decadal basis is also 50%. Every year, 50 fly in. The portfolio that Ashvin is managing, Little Champs, is intended to catch 15 of these 50. We don't have to get all 50. If we get 15 flying in with 55% CAGR, I suspect a lot of people in this line, ourselves included, will be very happy.
Right. Thanks, Saurabh. I think there's a question around the portfolio itself. What have been the portfolio changes in the last 3 months, given that most people think that the world has changed dramatically from pre-COVID to currently going through COVID, and factoring in our assumptions about how the world will change post-COVID. How does Marcellus adapt its portfolio exposure accordingly? I think this is a very important point for people to understand, the fact that we haven't made a single change. And Ashwin and Saurabh, if you can explain why we haven't made a single change, I think that will drive home the philosophy even better.
Sure. So across CCP and LCP, actually, across both portfolios, no new stocks have been bought in, no exits have been made. Obviously, that doesn't mean we've been sort of sitting here, staring at our Zoom screens. We've done channel checks. We've done forensic checks, as we were just explaining on the call. Our reckoning is, and again, I urge you to read the Howard Marks memo. It's on the Oaktree website. Our reckoning is, if you've identified category leading champions, they have high ROCs, they have bulging order books, they have buckets of cash, as Ashwin explained. You just have to sit back and watch as they make tons of money over the next 2 years, right? Let's take an example where the promoters come on TV and said so. GMM Pfaudler, Tarak Patel was on TV 3 weeks ago saying his order book is so heavy that for the next 3 months, they'll have to run the furnaces 24 hours a day, right? So this is GMM Pfaudler is glass-lined vessels. They make these giant versions of this coffee cup, as big as this room, with the ceramic layer being, say, a meter thick. They supply pharma companies like Lupin, Cipla, Divi's Lab, United Phosphorus, etc. Right? And obviously they haven't been able to produce anything through most of March and April, and hence through May, June, he'd come on TV to say May, June, July, their plants will go 24 hours a day to fulfill the backlog. Pre-COVID GMM Pfaudler order book waiting list was 9 months long. Right? That's the degree of excess demand this market leading company with 60-70% market share enjoys. Post-COVID, the pharma companies want those glass-lined vessels even faster. Why do they want it even faster? So once we heard him on TV, we were super curious. So we called up another portfolio company, which is also a supplier like GMM Pfaudler is to Divi's Lab, right? So we suspected that Divi's Lab, which is on our CCP, would be a trigger here, because the Divi's Lab, as several of you know, is the world's largest supplier of painkillers. Divi's Lab supplies 65% of the world's naproxen, right? So Divi's Lab functioned at full throttle through the lockdown. Divi's Lab itself, by the way, has not made any public announcement of bulging order books, but you just have to take a reasonable guess that they might have more API orders. Why? The world's top 6 pharma companies account for 85% of Divi's Lab's profits. If I'm GSK, if I'm Glaxo or Pfizer or Mylan, will I buy more APIs from China, or will I buy less APIs from China, right? And our inference was Divi's would buy less APIs from China. Will he go to Vietnam or Bangladesh? Unlikely. Pfizer or Mylan will buy less APIs from China. Will he go to Vietnam, Bangladesh? Unlikely. He's going to come to Divi's, right? We suspected it, but once we saw that both our Little Champs companies who are suppliers to Divi's have bulging order books, 3-4 months of 24-hour shifts looming for them, we realized that Divi's indeed has more business, courtesy the global majors ordering from Divi's rather than from China. Divi's in turn is ordering more inputs, glass-lined vessels, chemical intermediates from our investee companies. Our investee companies will make hay through the next 12 months, both in CCP and LLCP. The trick, therefore, is not to say whatever noise is coming through the window on how many people are dying from COVID. The trick, therefore, is to realize that if you have invested in market-leading franchises, with strong ROCs, strong cash flows, strong balance sheets, sit back, let the compounding machine do its work. The portfolio has done ever so well since 29th August. Our assessment is portfolio is perfectly placed to absolutely kill it over the next 3 years as we go through the shakeout, where lots of small businesses go bust and our companies go.
I think Saurabh's connection might have frozen. So one last question for you, Mark and Rajesh both. I think it's a very important question of portfolio management as well, which is exits. I like your views on how do you go about identifying. It's easier to say that when do we buy this stock, but what do you look to time that exit? And particularly given what you related to, Rajesh, if you could suggest, are there any signs that you look for when you're interacting with management teams that can help you time that exit as well?
Well, there are a number of reasons for exiting. First reason for exiting is that the company is not performing according to the way that you expected it to perform for one reason or another. It could be because of the industry, maybe because of the management, whatever. That would be one reason for exiting. The other reason for exiting would be you don't think this company is going to continue growing going forward. And that's a very, very important question to ask, because it's quite possible that you could be holding a company for 20 years because it continues to grow and grow and grow. So exiting is something that you've got to give it very, very careful thought. but you also must consider that the time frame does not necessarily have to be 1 or 2 or 3 years. It could be 10 years. And you got, when you're investing, you got to think in those terms. I know, Rajesh, if you wanted to add anything to that.
Yeah, absolutely. So before we invest, there is a certain investment thesis that we have, for every company that finds its a place in the portfolio. And like the team just shared, that there's been no churn so far because we haven't seen any reason to churn. So first of all, if a company doesn't perform to the investment thesis, and it's not about price performance, and I'll leave the price performance conversation to Saurabh and Ashwin, but if the company is not moving in a direction, or the business is not moving in the direction that we envisaged before we invested, then that's a question mark for all of us as to is, were we wrong in our assessment before we invested, or is there some have there been some changes on the way which have necessitated the direction that the business is taking now to be different than before we got in? So those are questions that you keep asking, and not just when you invest and have a certain investment thesis, but the investment thesis itself for every portfolio company is revisited every quarter. Whenever you see numbers coming out, whenever you see, like Saurabh said, management comes on television and says X, Y, Z, is that in sync with the story that we are following up, that we are chasing, etc. So there are good reasons to exit. Those are when the investment thesis has completely played out. And then there are bad reasons to exit is when the company and the investors like us, we don't see eye to eye, or we are not moving in the same direction. So I think our energies are well utilized with those portfolio companies where we are in sync with their thought process, and we are able to bring to bear our experience and value add, rather than investing our time and resource, behind companies where we don't see eye to eye with them, and they want to chart a very different, direction. And they may be right, but it's just not our vision, or it's not the vision of the portfolio. So, three, four times, keep that conversation on. The only way they will trust us and we will keep our trust in them is by spending more and more time with them, by demonstrating to them, for example, first of all, that we indeed add value to their process. And I think once that trust is established, once that relationship is established, then I think, we're all working in sync. So that is something we monitor very closely.
Thanks, Rajesh. Yeah. Saurabh, would you like to add a bit in terms of Little Champs specific exit strategies?
Yeah, so I think there are three things to sort of keep in mind. I think some of these the gentlemen have covered. So firstly, the promoter deviates from the core franchise which we were focused on. He takes free cash flow from the core franchise and invests in non-core strategies. He invests in serious free cash flow in non-core strategies. Will be deeply concerned and will consider an exit. Secondly, we notice the annual report season has started. As the annual reports come out, we'll go through deep forensics on the annual reports. If we notice hocus pocus, we speak to the company, hold them accountable, and if they can't explain to us anything funny in the annual report, we should be considering an exit. And the third thing is there is a natural speed of compounding that we expect here, right? So we expect earnings compounding, as Ashwin showed in slide after slide. We expect earnings compounding anywhere between 20 to 30%, right? Adjusting for smashed quarters like the quarter we are in. Adjusting for that, we expect earnings compounding of 20 to 30%. As these stocks get discovered, courtesy our blogs, courtesy whatever we highlight to the broader media about our holdings, we expect to see compounding to be a clip ahead of 20 to 30%. But if the compounding, the annual compounding starts being 50, 60, 70%, obviously we will have to start thinking about taking profits, right? So part one deviates from core strategy. Part two, governance accounting issues. Part three, compounding rather than being, a multiple of 20, 30% ends up being 60, 70, 80% because this happens in our country often. When the small cap mutual funds decide they want to build a 100 crore, 200 crore position in these sorts of companies, they ramp the stock up. If we start seeing disproportionate outperformance relative to profit growth, we should be thinking of taking profits. We don't have this latter challenge in CCP. In CCP, you rarely see compounding being many multiples of share price compounding, right? But in these sorts of small companies, it's entirely feasible Once a company gets discovered through us, and our blog starts circulating, our newsletters start circulating, and ultimately this portfolio starts circulating, and the thesis becomes apparent to lots of people, there is a good chance that the compounding will roar through as a much larger fund house than our modest fund decides to take a big size position. And if that leads to 70, 80, 90% acceleration in the share price, we got to think about booking some degree of profits.
Perfect. I know we are exceeding our time limit, but there's one last question several people have asked, and this is for Mark. Maybe two. I've got two last questions left. One is, Mark, given all the money printing and the $1 trillion of stimulus from the Western central banks, clearly the asset markets have held up despite what's happening in the real economy. What's the end to this? I think Stephen Roach wrote a nice piece on inflation coming back whenever the lockdown is lifted. Will that be the end of cheap interest rates and therefore the end of financialization of the economy? How do you see that play out?
By the way, I see there's about 168 questions coming up, and I've got to go because I got another call, but I'd be happy to answer all those questions by email. And I know Subaru will probably want to do that as well. But anyway, just to answer that question, I must say that I'm a little, maybe you can say revolutionary when it comes to the idea of inflation. I do not believe there is inflation. Inflation does not exist. We are in a deflationary world and have been in a deflationary world since the beginning of mankind. Because of technological innovations, life has gotten cheaper and cheaper. It's been easier and easier for people to get food, to get services, et cetera, et cetera. Of course, there are some people in the world that are in bad shape, they're hungry and so forth, but the numbers have been increasing dramatically over the last centuries. So that's the first thing. Now, what do we mean today by inflation? What we mean is money printing. The money is being debased, and every currency in the world, including the US dollar, is being debased. In other words, more and more is being printed. Of course, nobody knows what the money supply is, because with fractional banking, the banks are creating money every day. And then how about all of these I call them psycho currencies like Bitcoin. Nobody knows how much is out there. So what I'm saying is that, yes, you can see it looks like prices are going up, but it's not the price that's going up, it's the currency that's being debased and devalued. So how do you get out of this situation as a saver, as an investor? The only way is to get into investment that will adjust to these debasements of currencies. And that's the reason why we're so bullish on stocks, because companies adjust their prices in order to account for the debasing of the currencies. So I think people should not be concerned about inflation at this stage. Yes, the central banks are printing and printing. They have been printing for quite some time. Interest rates are going down to 0 or less. But the only way to be hiding from this disaster, this currency disaster, is to be in equities, be in companies that can adjust their prices to the debasement of the currency.
Right. If you don't mind, just one last question, given your experience in emerging markets. One of the other factors which has led to this disinflationary environment or deflationary environment has been globalization and efficient utilization of resources. And that globalization has clearly driven much of the gains that emerging markets have made by supplying to the West and the rich world. Given the emergence of this, pro-nationalistic leaders across the country, and particularly accelerated by the current situation where everybody is locking down countries, locking down borders, do you see the beginnings of deglobalization? What does that mean for emerging markets? And hence, therefore, again, reducing efficiencies?
Globalization will continue and will continue to grow. The genie is out of the bottle. We can't put it back in, because the way the internet communications are growing around the world, there's no way that people can be isolated anymore. we're now in a globalized internet world. And if you just look at the young people around the world, they are much more savvy than we ever were about what's happening globally. So yes, you'll hear some people, Trump saying that, you know, we've got to make America great again, because Modi wants to make India great, so forth and so on. But the bottom line is that all of these leaders have to adjust to the globalization that's taking place and continues to take place. And by the way, is very, very advantageous to emerging countries, because the emerging countries are leapfrogging the technology that all these other countries had to go through, all the steps they had to go through. The emerging countries are now adopting this technology and are really pushing productivity at a very high rate.
On that positive note, we'll bring the call to an end. Thank you so much, Mark and
Thank you.
Rajesh.
Thanks, Mark. Thanks, Rajesh.
Thank you. Thank you, everybody.
Questions.
Thanks.
Thanks,
We'll
everybody.
start
Thanks.
Thanks, Ashwin. Thank you. Thanks, Mohd.
So
Bye, everybody.
questions
Bye-bye.
if you're not answered, we'll answer you individually, as many as possible. Thank you so much for everybody for dialing in.